Let's keep me here. Who else would it be? This is a private video called How to Go Short, or maybe just Shorting 101. At the time of recording, it's going to be one of those titles. I haven't come up with a title just yet. Really, it's just based off of, feedback from what you guys have suggested. Somebody suggested that they wanted a video over shorting, and then that got some replies. So I thought I would go with this. Also, private videos are something that I want to do more. I was very consistent on. I want to get back into that consistency. So if you do have any other ideas that you want, please let me know. Just right off the bat. So if you have any other suggestions, or if maybe I don't clarify enough for this video, go ahead and let me know. See how that's good or not good or whatever. I will gladly take constructive criticism, and I'll cover that in the next video. Usually, I try to get 2 private videos per month. Sometimes I get 3, sometimes I get 1, but I'm trying to aim back for that, 2 per month consistency, and pretty lengthy. I might actually do more because usually those videos used to be about an hour, hour and a half, and I understand that that's pretty long, lengthy. I can talk for a while. I can explain things in detail for sometimes too long, and so I might cut them down, maybe give you like a 15 minute, 20, even 30-minute video, maybe just give 3 to 4 of them per month. So we'll see how that goes. Anyway, my point is, I'm gladly able to take constructive criticism for this video, so go ahead and let me know. So I'll get to the introduction here. So like I said, this video is about how to go short, or just shorting 101. And so we're going to just take a comprehensive basic look on what it means to short the market. Some of you are not used to it. And so just to give you a brief history of me, like I traded stocks in 2015. Okay, that's how I started my financial journey. And this, I got a lot of, personal finance prior to that, following people like Dave Ramsey, and, as far as like personal, getting a budget together, stuff like that. So not exactly trading, but just more like personal things like that. I was basically nearly broke at the time. And then I started my stock journey in 2015. I bought, I made, whether it's by luck or by skill or maybe a little bit of both, mostly luck probably. I bought only 2 stocks. I did not diversify, but the 2 that I picked were Nvidia and Square, and both of them did really, really well. Nvidia's still doing really good. Square not so much, but I've sold all my shares since then, except for maybe, just whatever I have left over. So I transferred that into crypto in 2017. First thing I bought was Litecoin at like $50. I remember, Bitcoin was probably 16,000 at the time, and I think it went all the way down to about 35 or whatever it was at the low of 2018. And so that's kind of how I started my crypto journey. Now, the reason I say that is because I didn't short anything. Okay, I did not short in the stock market. I did not short in the crypto markets as well until about late 2019. Yeah, roughly about summer of 2019, I should say. And so, I say all that to say, like, I was really scared to short the market. I was really afraid to do so. I was afraid of leverage trading. I was afraid that it would be higher risk. I've been told it's higher risk. And that's the thing. If it's your first cycle, or if you remember your first cycle, a lot of people try to scare you off, especially normies. Like, oh, it's a bubble, it's too risky, it's blah 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 blah. And so there's a lot of caveats to that. And so, if you are trying to be discouraged or trying to get me to tell you whether you should or should not short, this is not the video for you. All right, so as I said, the video for this is going to be called How to Short, or Shorting 101. I'm going to go over 4 different main concepts, and I'm basically taking this verbatim over what we discussed in the Discord group. So the first thing is, well, actually, I'm going to do 5. So the first one's going to be something that I'm going to introduce, like just the concept of shorting, very introduction, very base level. You could almost chat GPT that kind of stuff. And so I just want to have like a foundation so that we can be on the same page of what shorting really means. The second category will be, what strategies can I do while I'm shorting? I think everybody understands the idea of shorting, but how can we take advantage of this? What are some ways that we can do this that's different than just saying I'm going to short and that's just a gamble? Okay, so the main idea of that is, I want to make a strategy. because I don't want this to be gambling, and we'll discuss that, right? So the third category is how can I strengthen a short position. So if you already have a short position and it's working pretty well, how can you refine that? How can you create more fortitude to make that a really solid trade? And so I think that's a really good category that was brought up. So we'll cover that. The fourth one is what do I look for in technical analysis when it comes to shorting. So that's kind of similar to three. It's probably 3.1, so to speak. And so I'm going to go through what we can look for in TA. So like let's say like right now we got the Bitcoin chart. Like what could I look for here to short this? Okay, and we'll discuss that. And then last but not least, we'll have kind of an insight chapter. Like, what are some insights to be exposed to when the market goes down? So, like, what can I look at? And it's just very similar to the strategy one, but like, what are some hints that the market is telling me that we could um, go down? So, those are going to be the five categories. I'm already really enjoying this video. I think this is a challenge to me as well because I feel like these things I feel like I know these things, but then when I try to explain them, like maybe I don't, that gives me the opportunity to try to make sure that I know them myself and educate you with that. So, um, glad to kind of do this video. Let's get started. So first things first. First category is, well, how do we short in general? And I understand this may be something that everybody knows, and if it is, please feel free to skip through the next chapter. I'm completely fine with that. But I want to make mention of this just in case you need a refresher, or in case somebody doesn't know and they may not feel like they want to ask this. And so it's like, how do you short in general? So we all know what kind of a long position is. So there's really three ways that you can trade. There's more, right? But like when it boils down to it, there's three. There's you can buy, you can long, and then you can short. Actually, you can buy, sell, so and then long and short. So buy and sell is basically like say you buy here at like 69,471, and then you're just buying it. So it's like you go to Coinbase. Let's say you buy one Bitcoin's worth, you have almost 70,000, and you just hold it. And if it goes up, you make money. If it goes down, you lose money, right? So we all know what that is. Selling is which you probably already know as well. Let's say you buy here at 69,386 or whatever. It keeps fluctuating, but let's say you buy at like 70,000 and then it goes down to 65,000. Well, you just lost $5,000 if you have sold it. If you haven't sold it, you haven't lost the money yet. I mean, you technically have, but it's not realized. It still could go up or it could continue to go down. Right. So right. So that's buy and sell. Very easy. I'm pretty sure most people know that. If you don't, you probably shouldn't be trading, honestly. And if you don't, just let me know. We can talk. But you should know the entirety of this first chapter, or you should not be trading. At least shorting. And so now let's get into long positions. So if you go here on Trading View, you have something like long position, short position. Well, what is that? So if you go to long position, let's say your entry is right now, and so this is what that looks like, right? And so it gave me, sometimes, excuse me, the 7% on both sides is something that TradingView decides. Sometimes it gives you different results, but this is basically like your entry levels right here. If you want to long this 7% to the upside, then you would make money there you would make 7%. If it went to 74,137, and you would lose 7% if you went down to 64,226, right? So excuse me. So we all are well aware of that, I would assume. And so you can adjust this based off of what you want to do. So let's say let's just say we adjust this to basically 3, and so just assume that this is 3 instead of 3.02. And so the idea is if you enter now and you make that 7%, you still make that 7%, right, at 74,137. But if you drops down to about 2.37%, you only lose 1%, or you only lose 2.3% of that. And so this 3 here is the R value. I've mentioned this before, I'll mention it again. The R value is based off of your risk, and it's assumed by, it's long story, but it's assumed by percentage. So for every 1 R, it's 1% of your portfolio. Okay, not percent of the move, but the percent of your personal portfolio, which will differ. My portfolio will be different than yours and different from everybody else's, right? So you have this. So if you have a 3R trade right here, that means you risk 1% and you would get with the opportunity to gain 3%, right? So if it comes down here, if it loses 2.37, then you have lost 1% of your portfolio. If it goes up to 7.1%, you have gained 3% of your portfolio, if that makes sense. If it doesn't, please let me know. I can really break that down, do like and explain it like I'm 5 video. Happy to do that. Really am. So that's the long position. Now the short, now and the way that you can do this, probably the easiest is with leverage. Okay, unless you just have a lot of money, right? Um, or unless you put 100. I shouldn't say. I should say not necessarily money. It's your risk. You're on risk of your portfolio. The only way that you can actually lose 1% here is if you put 100% into your Bitcoin right here, unless you use leverage. Okay. Now I want to be careful because shorting doesn't necessarily have to be leverage. Like it's very unlikely that you're not using leverage to short. Like you pretty much have to. There's ways around that, but um, I want to be careful because shorting and leverage are going to be two different categories. Longing and shorting, like you will probably use leverage when you long or you short, but that doesn't mean that you should put them together as one unit. Okay, you should think about them very differently because they have their own unique disciplines, right? And one is a tool, leverage is a tool, right? Whereas long and shorting is an action, right? And so just some clarification. So that's longing, but shorting is really just the opposite, right? So let's say here's your entry here, and now this becomes your stop loss position, and so and this becomes your so say we put that here at the 1.6 almost, and try to get that same 3R. Sorry for the different colors. I try to distinguish the different colors so I can get a quick visual on my charts. So this is what a short position is. The same entry is the same, but your stop loss is also your stop loss percentage is the same roughly. Let's just assume that it is, and your take profit is roughly the same as well. So you have the same R value. You have 3%, but the idea is that if Bitcoin goes down, you will be making money, and if Bitcoin goes up, you will be losing money. So that's the big difference. And so again, I know this is very basic 101 stuff, but I want to make this distinction because most people by default will spot buy. Okay, um, people that use leverage for the most part will long. Okay, and but some people won't short, or they may use too much leverage. Again, leverage is not the same necessarily as longing and shorting, but it kind of is in this particular discussion. And so that takes a different discipline. Now, the reason I make this distinction is because longing and shorting can give you two different ways to look at it. So there's a few things. One, like shorting is very limited in its downside. Okay, and I'm not personally a big fan of shorting in general. But I will try to short only when there's a really good opportunity. I'm not a big short person. Okay, I'm not into shorting a lot. I tend to look at things where let's say like if I believe, for example, let's say this goes to a full target, right? And so let's just say like right here, right? So let's just say Bitcoin will go down to like 64,000, 63,000, and from current price, you could hold this, and then it could go to target, and you would gain 3R on that. Okay. Now some people are really glad to short. Okay, again, I'm not saying that you should or shouldn't in this example. This is just a tutorial education, idea. Um, if you did this, you would lose money, right? So you'd lose that 1%. If you kept going, you would lose 3%. So we'll just get rid of that, right? Here, you would gain 3% to full target. Now, sometimes, and this is I prefer to do this unless there's a really good opportunity. But in high time frames, I don't do this really at all. Is to short the market. What I tend to do instead is like, all right, I'm anticipating this going down. Maybe I'll off risk, I'll sell something, and then I'll buy on the way down because and so there's a difference here. If you believe this is going to go short down to 64,000, then that is short worthy. that is a sign. Shorting is a sign that you think that not only that the price will go down, but that you can take advantage of the price going down. Okay, DCAing and buying on a dip is understanding that the price may go down, but you can't take advantage of it by it going down. There's a big difference between shorting and DCAing and buying dips. Shorting implies that the market, you anticipate the market going down and you can take advantage of the market going down. Whereas DCAing is you anticipate the market could go down, but you don't know how to capitalize on that. And so buying on dips and DCAing would be a way to mitigate that, right? And so the idea is with DCAing is like, let's say you think the market's going to go down to 64,000, but it'll bounce, right? So let's say you buy here at like 66, you buy, twice as much here at 63. And then by the time it goes back up to 66, 67, let's say, you make your money back. Okay. And that's the concept. So that's the big difference. And I need to make that distinction because shorting is its unique thing. A lot of people will try to short when they should be DCAing. A lot of people DCA when they should be shorting. Okay. And so there's a unique discipline there. Longing and shorting is not the same in its application, in my opinion. And there's several factors. Another factor is, especially for those that are in the United States or depending on the platform that you use, you can only leverage trade for 28 days. Okay. Some of you can do perps, which takes longer, longer than 28 days. Some of you guys use standard futures, which takes USD values. Some of you take perpetuals, or coin M futures, which would allow you to trade with Bitcoin itself instead of Tether in this example. So there's many ways to do that. It's a little over. That's a little higher shelf than this video, I should say. It's more of a 102 type of analysis. So anyway, that's how I'm looking at this from how to short. Okay, so that's the idea. Very basic details. That's going to really vary depending on your risk tolerance, your portfolio, how much you have, things like that. I could, you know, bring my own presentation. I personally don't think that you should be shorting unless you have a certain number of capital already. But I will digress from that in this video because that's going to be your personal preference. Okay, I personally think people shouldn't really short unless you're just really, really used to it or good at it, or unless you have a substantial amount of capital to where um, you may not blow your portfolio because shorting, in my opinion, shorting is more difficult. Now that's somebody with 8 years experience, but with limited shorting experience as well. Not that I have limited experience, but like it's you try to figure out your strengths and weaknesses, right? And so with something like Bitcoin that tends to be a risk asset, but also one that tends to go up often, I tend to favor longs much better because there's always been more upside with Bitcoin. So anyway, that's the first section, how to short. Let's go ahead and go to the next section and talk about certain strategies that we can use to take advantage of shorting. Okay, so now I want to kind of go into the strategies. So, like, what kind of strategies can you make with shorting? You understand what shorting is, you know how to do it, right? Things like that. And for starters, um, like I said before, it's going to be different than longing the market, right? But in some ways, you're also going to take kind of the same approach. Like just as you try to find ways to long the market, you can find ways to short the market. So here's some basic. These aren't going to cover everything, but instead of trying to make like real critical like verbatim strategies, I decided to have three of them that like three strategy categories, I should say, because all of I'd say 99% of all strategies are going to fall into these three categories, and then you can work your way backwards, so to speak. So like look at the categories and see, and it'll depend on the type of trader you are, of course, and then you could try to look for those strategies more in detail. And so the first one is going to be more of a trend based idea. And so these are going to take, again, this is a whole category. I think the best example is going to be moving averages. And so I went ahead and added, I added the 200 here, but I kind of want to focus here on like the 15, for example. And this is, again, just an example. It's not going to cover every category. And I think if I try to cover every single thing, this is going to be a week long video. So I want to just kind of cover the very basics into these categories. The first one is the trend category, right? And so you have something like this, and this isn't particularly perfect, right? Because you know I can give you this example. You look at the trend, and you can short whenever the trend goes negative. So, for example, this goes up, you could short when this comes back down, right? And so you could do something where, let's say your entry level is at the close, and then you just go ahead and target that local high since it's less than 1% anyway. And then if you would have gotten out here, you would have gotten that 1R. So that's not exactly a lot, but that's just the idea that I'm looking for. A better example would be just right over here, right? So where you have your cross below this zone, you target here at the top, or you could target the high, you could target the close. This will really depend on your risk tolerance. But if we do that, and then we target below here, and so for example, this would go down to about 5.4. So that is a trading strategy that's based off of a trend. Now, obviously, I'm looking at hindsight data, so I can kind of tweak that to be more successful than it could be in practice, right? But not necessarily either, because that's where you try to gain an edge. That's where the insight thing will show up, and so you could you could put this together with other data. For example, let's say if you're short in the market, then the RSI is going to go down, right? So what if you decide to stop when it goes when it goes below 35, for example? So you put your little excuse me your line here at 35. And so when it finally, when you're short in the market and it goes down to 35, actually we could even do it farther and go to 30. And this will depend on what you want. Like what I would look at with this is look at an asset, like let's say Bitcoin, and see like what's usually something that's on the bottom on a certain time frame. And then put your entry here, your stop losses above here, and then once this goes down below 30, which would be right here, right? Um, Here is the closing candle for the 30, and so that would be right up here. So you have a 3R trade here, and that was successful based off of an actual trend based strategy, and you use extra conditions to target that strategy. So this is threefold. One, you have the idea to short, right? So you're looking for shorts. Two, you have a trend based strategy. That's the category. And then three, you set the conditions. So there's two conditions. One, that you short when it goes below, in this particular example, the 200 EMA. And two, you take profits when the RSI goes under 30. Okay, so that's kind of how that looks. Now you can also do the other thing with longs, for example. So using this example here, let's say you long here, you short, you have your, let's just say here, and this is something that I've suggested before, or talked about before, where you have your stop loss below the previous candle, and then you wait for this 80 marker, and so you got it right here at this big candle, and so that's a 3.53 trade, right? And so both of these took place. Where's it? over over the course of a little bit over a day, about 25 hours, 20, almost 25 and a half. So within 25 hours, you got 6.5R, which is pretty good, right? I think that's relatively good for two trades. Now keep that in mind, that if you tried to short this here, this would have maybe not stopped out. It depends on your conditions, right? This one may not have done as well. This one may not have either. But if we're talking about shorts again, we can look at this from this zone here. This probably, so this one's tricky actually, but I'm going to give this an example. So if you waited to the candle close, this would be your entry, right? And so that's your stop loss. So that never came back below. So you might look at this and say, well, it didn't reach the 30 RSI, but it did all the way down here, right? And so this would be your target at this candle. And so it would be right here. So 1R, again, not overly impressive, but that's the idea. That's the trend-based idea. And so the more conditions that you add on that, the more you can take advantage of that strategy. And again, you need to understand, just like sometimes longing doesn't work, sometimes shorts may not work as well. but this is just an example that I'm using, right? And so here's a big long, um, so here's another example of shorts. Now you also got to keep in mind that in an uptrend, and I've said this very recently on X, is that um, you need to be careful trading bi-directionally, especially during an uptrend. So I personally don't trade bi-directionally. So what does that mean? So if the high time frame is long, okay, and so um, right now, like the A rune for me is bullish here. I am not interested in shorting because the high time frame is long, okay, and so that may or may not be good for you. Some people like to short when it's. I don't think most people even really put that in perspective. But for me, I only long when the high timer is long, and I short when the high time frame is short. So, for example, here's another big thing. Here was your drop off from the previous cycle. We had this big swing, right? And so that may have not been helpful, but this was very helpful. This was capitulation on, in my opinion. And so just from here alone, that was about 55%, and all the way to the bottom was about 65%. So this was the meat of the move. This is probably your biggest ratio between the least amount of time and the most amount of drawdown. Okay, so that is by definition capitulation. So you could take advantage of that. So let's go ahead and I'll use this as an example, right? So I'll mark that, get rid of this, and let's just go ahead and go back in time here, and then you try to utilize this. Okay, and so you have your 200, right? So, and again, this is the daily, mind you. So you have your short position, entry, like I said before. Stop loss is the previous opposite end of the candle, so that would be the close or the high, depending on your preference. And then you wait for this RSI to go down. So let's say we go back to 30, right? And so there's your zone right here. And so that's basically one of these two candles, right? And so if you go here, it's about 2.7. If you go here, it's even farther. And you can continue to do this. You could even have raising, trailing stops, things like that. And so that's the advantage of using something like a trend. Now, again, it's not the best example. I think it is actually a better example than I'm kind of saying, but I'm using this as a 100% trend based idea. Okay, this is only using trends. Okay, it's not using really anything else. So that's the first example. The second example is actually very similar, and or not similar, but it's going to be in the same area right here. So I'm going to get rid of all this, right? And so the second so I'll take us one step back about the trends. The reason I mentioned trends is it's also the reason I said it first, I should say, I apologize, I'm stumbling. The reason I said it first is because it's the most basic. Okay, everybody can understand moving averages and trends. The second one is kind of in the middle, and so these are going to increase by difficulty. The second one is going to be pattern based. Okay, and so the first ones are going to be trend based. The second ones are going to be pattern based. And for my notes here, I'm focusing on things that have been high probability for me, which means and from my experience and my backtesting history on the charts, that they have a good probability of success. There's no guarantees. But the patterns I looked at are deviations, rounded tops, and channels. Okay, and so we can cover all three of these on this chart right now. We don't have to go anywhere. So I'll get rid of this too, because I also want to give you a different take profit strategy. So the first one's going to be deviations. And so if you have your short position here, so what is a deviation? I probably should mention that first. And so in order to look at deviations, you need to look at order blocks. So right here, this is an order block right here. Okay, and so so you have two deviations on here. One, you have this zone deviation, or a order block is really just a commonality between supply and demand. Same range highs, same range lows. This is your range high. This is your range low. Okay. Deviations are when they deviate from the path. And so if this comes above here, you could probably long this. Now, the trouble with longing this at this zone is because you're looking at this with a certain replay history, right? So you're only looking at this. This would have not have been a deviation at the time, right? So you need to be careful with that. This, however, was a break above the zone, and then all of a sudden it deviated below. And so once it came below this zone, this became a deviation. This is one reason also why this could have been the candle to trigger the whole capitulation, because people were already complacent. And so we thought we would reclaim this, and it didn't, right? And so this is a deviation as well. In fact, honestly, this entire weekly structure was a deviation right here. And this is one I got out of the market based off of this deviation. It went up above. We did not have a divergence. We did on the 3 week, I believe. But then we deviated below, and once we closed below this, because this closed through the entire block, I closed here at 58,600. That's where I closed my entire portfolio. Now, let's go ahead and go back to where we were, and look at this from a deviation perspective again. And so once this closed in the zone, this was a deviation, right? So now we can short this very similar to how we did before. And then you could do different things with this. Now for a deviation, my personal preference is to just target the entire high of the deviation block, which would have been this, right? And so this is your deviation block. My stop loss would equal the highs, because you're not anticipating this to stop. Deviations should also not come back above, by the way. If it doesn't, if it does, that means it's probably going to go through anyway. So another option that you could do as far as stop losses is go ahead and put that fib block and then put it right here at the mid. And so that would tighten your stop quite a bit. Deviations tend to be they tend to run away from its previous position. The whole point of a deviation is it's not a valid price point. And so if it's not a valid price point, it shouldn't return back there, right? So that's how I would view that. Now, if you wanted to, you know, so you could do this a different way. You could look at this from a divergence perspective instead of an RSI perspective. If so, this is your divergence, right? And so then the candle that created that divergence could be your take profit. And so that would be right here, at this candle right here. And so that would be it. That would be a 4R position. So that's, again, that's just an example. There are better examples. There's worse examples too. But this is a very solid textbook example of what I'm referring to. Now you can do this various ways. You could have targeted 20,000 if you wanted to, or 25,000, and that would have, given you something else. It just depends. And again, hindsight's 2020. You may not have thought it would go to 25,000 or whatever, right? So you can determine that on your own as far as the take profits. I'm just teaching you strategies to short. So that's the first option in this second chapter is deviations. The other thing is rounded tops. Same thing as rounded bottoms. Now, in my experience, rounded bottoms, Adam and Eve structures, Adam and Adams, Adam and Eves, those are basically all double variations of double bottoms. And so that's kind of, the inverse of that, double tops, would be what I'm looking for. So right here you have a double bottom here, and so you got 1, 2, and so you're kind of looking for something else on the opposite side as well. And so see if I can find one here. I thought I had one, but I didn't. And so this would be one. This would be kind of a double situation here. The trick is that sometimes they don't always happen on the short side, going short, I should say. So here's kind of a double top, and so this would work for you. So as soon as you get this double high, like so, okay, this one was a failure, right? This one was a retest. This came back down, and this also classifies as a deviation because it made a new high and it came back down. And so oftentimes you're going to find that deviations, divergences, and rounded tops, double tops, are going to be almost in the same spot. Another thing is bearish divergences, which is what you have right here. You had a bear div. I'm kind of bouncing around, but here was your bear div. You could have shorted here, put yourself at the highs, and then you could have targeted all the way down. Your target could have been the 200 EMA, and that would have been 4.1. So that's another option to short that. So just another idea. But you have the double top here. And so this would have been your short scenario here. You put your entry here, you put your stop loss here at the top. Okay, this would have came back through, but it would not have, you would not have gotten stopped out on this. And if you wanted to target that 30 percentile on the RSI, that would get you roughly right around here. for about 3.5, 3.6. So that's just another idea. Again, your take profits, your stop losses are going to be different. I'm mainly just talking about entry strategies, but take profit, things like that are really good. The overarching issue with take profits, in my opinion, and this is an Apex system thing. If you are not familiar with Apex system and you want to be, I teach an academy that does this, but the too long didn't participate is that you want to close longs and shorts when there's exhaustion. So if it's on the long side, if you're long from here at like 68,500 and you get a divergence here and it's not a long-term trade, you want to cut that trade. Okay, because you're anticipating this to come down. That doesn't mean it's always going to happen, but in most cases it does. Okay, and that's not guaranteed. The future results are not guaranteed with that. Now the inverse on the short side is also true. Is if I get a bull div, which I got one here. Now I may not have gotten candle wise, but it may be on the 30-minute chart. Then I would cut my short. So if you're looking for a doom and gloom position, you get the divergence, and you cut that out, right? And then you also cut that at the bottom, okay? And I'm telling you right now, that's the exact reason why I can target tops and bottoms, okay? I can take profits at tops. I can buy absolute bottoms, and then also vice versa, because I'm able to identify the weakness. Aaron also allows me to do that in some sense. RSI has a big part of that, more than Aaron, but all that works in tandem. That is my Apex system that does that. So that is anyway. My point is that's how you do a rounded top, and even a bearish divergence. And so that those are the three that are introduced with the pattern strategy. There's other patterns as well, channels, things like that, that we can look at. Perhaps I can look at a channel, and I think one of them was really back here from the previous range. And so you have a few. Here's two examples actually that I see. Here's a channel right here, and so you had your channel like so, right? And so once this breaks, you could short here, okay? And that's below the 200, everything like that. Your stop loss for me, again, this is my thought, is really the highs of the other side of the channel, right? And then you take profit. You could take profit again at that divergence. I'm a big fan of that, and that's a 2.4 hour trade, right? So again, hindsight's 2020, but that's just a tutorial example. Another example would be looking at this from an order block zone, okay, and treating this as an order block. I know this is a deviation, but let's just say this is a whole block, and then you wait for that breakdown here. Short, you got a really good breakdown, really close to the entry. That's an ideal short position, okay. Your stop loss is on the other side, because most of the time, once this breaks, this doesn't really come back, so you could do that, okay. You have no divergence here, but again, you have like the 30-25 RSI. You could do either one of those, and so you could kind of work with that. If you got here in the middle, it's 2.4, right? And so again, you could adjust that according to your strategy. But those are examples, the deviations, rounded tops, divergences, and then really two channels, two types of channels. One's just an order block channel. One's an actual textbook channel that we refer to. So that's the kind of mid-level strategy. And so let's kind of go on to some higher level ones, which I don't always think are the best, but we'll cover them. So the third strategy is what I call high level strategies, and I don't necessarily mean high level as more successful. I mean more high level as complicated. So depending on the type of trader you are, this may be very beneficial to you, or this may not be beneficial to you. I tend to be naturally more into easier strategies, and then I refine those easier strategies, right? So I look for high probability trades, and I just keep trying to refine them to try to like literally try to get my strike rate to like 99%, or like at least 90 or higher, right? And so these in particular, these quote unquote high level ones, can work. I know a lot of people that use them and they work very well. But for me, they may not be for you. Some of these aren't for me, but I added them in there. So the main three are going to be swing failure patterns, engulfing candles, and then engulfing rejections. So we'll kind of look at these all at once, honestly. And so like a swing failure pattern, here's just an example right here, is that you had to push up to the zone. Um, it went up all the way to the highs and then it rejected here. So that's pretty much the classic behavior of what swing failure patterns are. And so your entry level would be at the close. Your stop loss could be wherever you want. I typically put it at the highs, like I mentioned earlier. And then let's say even if you just went down to this here, that would be a 2.8, right? And so that's the idea behind swing failure patterns. They are highly dependent on regular Japanese candlesticks. So you can't do them with line charts, can't do them with other things. And so that's one of the ways that you can do that. Now, there are also engulfing candles. And so here's an example here. I want to kind of give a better example actually, because that didn't do very well. Let me see here. So here's a good example. So you have your push up above here, and then this completely engulfed that candle, right? So this would be your short option. You again target the highs with that, and then let's say you just target the lows. You got like a 2R or a little bit over 2, and so again, that's the idea behind that. So you can look for a certain candle structure. Now, me personally, I acknowledge that's the case. Like I think swing failure patterns are completely fine, engulfing patterns are completely fine. I've noticed that they're a little bit lower probability for my comfort level. I prefer things with much more surety. And so, but I went ahead and added them as well. Now, I do want to add a hidden fourth category of just other strategies to look for. And I waited for this because it's kind of like, three, because I mentioned the first strategy is trend based strategies, second one is pattern based strategies, the third type is candle based strategies. And so this fourth one is kind of like in a subcategory of the candles, but I wanted to add it as its own category. And so this would be, excuse me, this would be uh, uh, breakers, so bullish breakers, bearish breakers, retests, and then I also added volume. And so you could look at volume. I'm not going to discuss volume in this particular time because I think that's kind of low probability, but people do use that. So, but as far as breakers go, are one of these things where you have a zone. Let me see if I can find one. Um, so here's an example here. So a breaker would be, so you have this structure, right? It goes up like so. You have this area right here where you had a jump above, retested the lows, reclaim. So now this deviated, right? And so this isn't a full textbook deviation. That doesn't matter. What matters is you had a strike through completely through the zone. So what this did was it went through this area right here, and then it also went through this area right here. And so when a candle of this caliber goes through two sets of things, that becomes a breaker. Okay, and that means it breaks. It basically breaks the structure. And so when it does that, it's going to come back up eventually to this level, but it's going to retest down. Now, this is a bearish breaker, and so what you want to rely on is that this would come back as a retest. And so you have this like so. You want this to retest the mid. As you can see, it retested there. And so your short idea would have been something like here. You want to target on the outskirts of this, and then your short would be, I mean, that's not fair to put that as a 3.2, but that, again, that's just textbook. So that's how that works. But the reason I say that to last is this is very complicated, right? I'm not expecting you to get the hang of that right there. And so those are just some ideas that you can work with. So again, my preference is to look at easier ones because why make it harder on yourself to make not that much money? So like for example, like let's think of this in terms of hours. So if you have easier strategies that let's say combined only take you 10 hours a week, right? And then with those 10 hours you can make, 20% profitability. Let's just say let's do a different way. Let's say you have $100,000 and you have 20 hours a week to do something, right? And so let's say you spend 10 hours to gain, say $20,000. So that's 20%, right? But let's just say for a high level or these other strategies, you have to put a little more work into it. Let's say you spend 15 hours a week doing that, but then you only get 25%. Like, is that extra 5 hours, worth that extra, 5%? That may be, and it may not be. That's up to you. It depends on your time, depends what you value, depends on your portfolio, and that plays into it. So you can be the decider of that. So anyway, that is the strategies that I have with that. All right, so I acknowledge this video is getting a little long, so I'm gonna do this as a part one and do the part two later on, probably tomorrow. So the part two will just continue, and so we'll focus on how to strengthen these short positions. So you already know how to short. You already have strategies, categories of strategies actually to kind of figure out how to take advantage of shorting. And so now we're going to look at how to strengthen those positions, and then after that we're going to look at what can we look for in technical analysis. We did cover some of that in this video, but we'll refine that. And then we're also going to look at some insights on how to be exposed when the market goes down. So anyway, that's the first one. That's part one. Get ready for part two. Again, let me know if there's anything you want me to critique. That way I can fix it for part two. Go ahead and let me know. I'll see you next time.